Hello everyone. Hope you're doing well. So we were planned for 5 p.m. but then the schedule moved early. Hope you're all doing well. So yeah, so this panel we're gonna talk about exits. And yeah, we have 4 panelists with us today. I'll go quickly with introductions. Everyone, if we can introduce yourself, your fund or your background, and if can each of you explain also your experience with exits, M&As, IPOs, whatever, so that we can use this to drive the conversation forward. So maybe I can start first, introduce myself. So I'm Amir Sharif, was a founder of Wazzaf, online recruitment platform that I managed here in Egypt for 12 years, and recently moved this year with venture capital fund, Khwarizmi Ventures in Saudi Arabia. We have actually one of our portfolio companies exits, so we have Fatura, Hosam was Fatura, so one of our entrepreneurs who actually went through a recent exit, one of the most successful exits in Egypt. Yeah, I've done previously acquisition during my company, and yeah, that's about myself. Khalid.
Hi, so Khalid Lababidi. So I'm a partner at Arbor Ventures. We're a fintech-focused VC. We invest really in 3 core markets. We do Japan to Malaysia. We do a little bit here in the Middle East, and then we do North America. We have about 40 companies in our portfolio. We've had about 12 exits, varying ones. We've done IPOs, we've done M&As, we've done secondary sales, we've even done a SPAC. I'm happy to share a little bit more information on that, but so far we have one main investment in the Middle East, which is we're the seed investors in Tavi. We're really looking forward to doing more in the region as well.
Yep, Mohammed.
Thank you, Amir. Hello, everyone. Mohammed Ali-Eddin. I'm a principal at Global Ventures. I'm looking after Global Ventures investments and portfolio out of North Africa and Levant. Before that, I started in VC as well. I've been 5 years in the industry, but I started more on the growth stage side, and that's where I saw a lot of exit opportunities on both sides. So I've played on the sell side, I've played on the buy side as well, and with Global Ventures particularly, we've had about 5 exits to date. I've got the chance to witness some of them. We typically invest in Middle East and Africa as a focus region. Now we also added Pakistan to our regional focus, and we have a 20% allocations towards global investments. We have few investments in the US, few investments in the UK, and it follows.
Yeah,
thank you.
Hosam.
Hello everyone, this is Hosam Ali. I'm one of the co-founders and the CEO of Fatura. Fatura is a B2B e-commerce platform. We connect small merchants, small retailers to wholesalers and manufacturers. We are an e-commerce and financing platform. You have been in the market for 3 years, and recently you have been acquired by Tanmea Microfinance, which is part of the EFG Hermes Group, which is one of the largest financial institutions here in Egypt. That's it.
And finally, Mohammed Nagati.
Hello everyone, thank you Amir, thank you Techni Summit for having me today. I'm Mohammed Abu Naga. I go by the name Nagati. I serve as the executive chairman of Exits. So it's very obvious that I'm focusing on exiting companies now. I'm a computer engineer. I set up a small food and beverage fund. I sold it in 2012, and then I joined Fawry. I stayed in Fawry between full-time and part-time around 7 years. I used to lead the business development there, and I was an advisor till the IPO in 2018. And then I served as the regional director for Careem till their exit to Uber in 2000, and I lost track of the years, but I think it was also 2019. And then I joined Halan as a co-founder. We started a company with 2 other co-founders in 2018, and we also made sort of an exit and a merger, a hybrid last year, turned into M&T Halan, and we just had a small round last week. And I also serve as an advisor to Disruptech that invested with Hosam in Fatura. So we also gained some fruits of the exit. I also founded an accelerator called Cash Cows. We did 4 exits within Cash Cows from our portfolio companies. And now we just acquired our license from the FRA for fintech investment banking to trade companies in the Middle East and Africa. And inshallah, we also aim at having a secondary shares market soon. Thank you.
Thank you, everyone. So maybe we can start off, getting an idea of the exits landscape or market in Egypt region versus global. I believe that the region has been maturing very quickly over the past few years, but I think one of the areas that is still lacking is the part about exits. More companies, seeing more companies exit in the region. The number of IPOs we've seen, I think, is very limited. A lot of the IPOs we've seen, or like through SPACs, for example, the past few years were not as strong as we'd hoped, and yeah, the number of M&As I think is also very few. So Khaled, if you can start, like, given your fund's experience with exits in different regions, and now maybe you can compare and contrast the exit markets in the markets you operate in versus MENA. High level view, how do you see our markets?
Yeah. So maybe just to put some context to it. So when we think about exits, one of the main places we kind of think about it right now is in the M&A market. And so one of the things that we've noticed this year is there has been a remarkable, reduction in terms of the M&A market. So last year, you looked at it, there was about 360 acquisitions that were being done. This year, we're down to about 60. So there's a big change that's happening there. The other thing that's changed in the exit market as well is really IPOs. We're not seeing as many IPOs being done this year as there was in the last couple of years as well. So where do we look for exits as part of Arbor? We kind of look for them in 2 different places. Number one, we look for them really for the secondary funds that are out there. And that's really the best place for a VC to exit to. And the reason why I say that it's the best place for VCs to exit to is really when you kind of think about it, there's no escrow, capital that needs to go into when you do a secondary fund sale. Whereas when you do a sale as an M&A, there's always some sort of escrow that's there, and then when you go into IPOs, there's always escrow or lockups that happen there. So for us as VCs, we find that the best place to actually exit into is really to other funds who can take us to the growth stage and then possibly the IPO stage. Now, when we kind of contrast like what we're seeing in the region, one of the beacons that we see here a lot is really what Saudi has done with Tadawul, which allows for an IPO market to happen for earlier stage companies. And so I was just looking at the numbers the other day. I mean, just this year alone, Tadawul has done $10 billion worth of new public market offerings. And of that 10 billion, that was all 10 times oversubscribed. So there is a market that's here for the Middle East. And I think that's one of those kind of beacons that I think we should also start to look at as well.
Yeah.
So
okay, thank you.
Maybe more of the region.
Mohamed, if you can also highlight more, given Global Ventures focus on the region, and also maybe also explain the need or the timeline for exits from the VC perspective as well.
Sure. Actually, I totally agree with what Khaled just said. Maybe I'm slightly different on one part. I don't think that we have to take the journey or join the journey from A to Z. And maybe at one point before that, we can identify, from a timing perspective, identify like the right time for us to exit and come out of the company. And if you look at the region, particularly over the past period, there's a lot of unannounced exits that took place, particularly for investors and for VCs out of the cap table, which kind of guarantees some sort of the targeted return, maybe slightly less. We're speaking if we're underwriting for 10x multiple on your returns, and then you get an opportunity for 7x, but there's a lot of strategic value add for the company and the founder, then we tend to kind of see like maybe that would be an opportunity to take. So maybe I would say that I'd rather kind of stick a little bit towards my initial underwriting value, and if I'm able to reach a level where I can find a good multiples on my investment from a timing perspective, then from a present and terminal value of money as well, it might make sense for me to exit early rather than to wait for the full journey, and also give an opportunity for other investors to come on board without putting a heavy dilution on the founder at one point. So that being said, I think we are kind of a little bit more flexible towards exits as a firm. Rather than sticking maybe to the long-term holding. And that's why, like, Global Ventures is a 4-year-old firm. We started investing 3 years ago. We've had 5 exits already. Speaking about DPI, it's 0.7 on the first fund. So kind of showing a very good traction when it comes to a very early stage VC fund in that time frame. So I would say at the very beginning for us, as long as I meet what we are looking for from a return perspective, also being super mindful of the founder and their needs for the coming period and how can I help, and if that kind of, I can find like the right balance here, we are totally with exits actually, or early exits I would say on that front.
Great. We can go to Hussam now, the founder on the panel. We just went through just a fresh exit. It was like many people might have seen it as an early exit, but I think definitely I think it was a great timing given the current market conditions. If you can walk us through the mindset of you yourself as a founder, thinking about such an early exit versus continuing and fundraising. What's the mindset when you're doing that? When should founders consider that? How did your experience was with investors when you told them that you were considering exiting the company? Yeah.
Thank you. Yes, I would. Some people thought this is an early exit, and this is probably true from a timing perspective.
It was like 2 years, or
yes, it's like 2.5 years. So
yeah.
We haven't been for 3 years in the market, and then we decided to exit. But then one idea here is that this was not the first time we were approached actually for an acquisition. We not a lot of people know this, but we received like multiple acquisition offers, but we never entertained them. This was the only acquisition offer that we entertained, simply because it was in synergy with what we believe in. I mean, when we explained Fatura as a vision to even in the onboarding for our employees, we said this is a pyramid where e-commerce is the base, and then you have financing, and then you have payments. And then we were approached by someone who would help us accelerate our vision towards financing, because Tanmeya is the second largest microfinance entity here in Egypt, and EFG Hermes Group in general is one of the largest financial institutions in the Middle East. So they would actually help us really realize our vision. And another idea is that this was a partial exit. So this was not a full exit. So we didn't leave the company. I mean, the co-founders are here. They are actually on this table, and they are still in the management of the company. And we are working towards our next milestone in terms of the vision for the company. So it was not a partial exit. It was not a full exit. It was a partial exit. And it was a very strategic exit in terms of where it takes us. I mean, it saved us 2 to 3 years of building microfinance knowledge and microfinance power, and being able to grasp this market opportunity very, very fast. So from our perspective, that was kind of a one-in-a-lifetime opportunity in terms of the synergy that you will find. And it also paid off in terms of being a partial exit. As first-time founders, partial exit was very important for us. As a success story, also financially, on so many fronts, it was very important for us to have such an exit. So in our case, since it was a partial exit, in synergy with what we're doing, we're still believing in the vision, and we still continue to do what we believe in. And it had a partial exit component, which is very important for us. So the stars were kind of aligned. But I agree with you that if you look at it from a mere perspective of timing, it's early, but it was also the right time for us.
Yeah. And since we have a lot of investors in the room, like, is there like any advice you would tell investors with, dealing with similar cases with their portfolio companies from your interactions with your investors during the exit?
Yeah, I think it's very important to align with the founders from kind of day one, and to have some expectations. Like the first-time founders, they have some expectations and some aspirations to actually exit, and this is typically clear for the investors. But then when you approach an exit opportunity, you need to be very close in terms of what do they want, and what are their ambitions, and what do they see next. Because the calculations can be different at some point, right? An investor who just joined the previous round might look at it from a multiple perspective only, but for the founder, this is their lifetime project, and this is their lifetime risk, and they are, they are in it for good. So they are doing a partial exit, so they really believe in the vision. So I think it's very important to kind of consider the founders' aspirations and ambitions very closely as they approach an exit, because naturally some investors who joined early will make more money, who joined later will make less money, still make money but less money. But then the conversation would be have to be very considerable for the founders, for what they want really.
Yeah. Did you were all your investors supportive of the decision from the get-go, or you had to some were resisting the?
I think that would be too ideal to be true. That everyone, not all the founders were aligned in the beginning, right? And the process wasn't like a 2-month process. It was a 1-year process. So we had, from the moment we started, the discussion was initiated with us. That was in July 2021, and the exit happened June 2022. So it was 1 year long of syndication, of back and forth debates between the founders, and then between the founders and the investors. Some investors from day one were very supportive. Some investors, it took them time. Some investors only got convinced of the deal after the deal happened. And this also happens. But then, so it wasn't pretty much aligned 100%. I'd be lying to say so. But what worked for us is that all investors, even if not convinced, they actually supported our decision. So they would tell you, I think this is too early. I don't think I would support this. Some investors, of course, but then they tell you, I still support your decision. I still, I'll do what you'll go for, and we really appreciated that from those investors who were not on board. Yeah.
Great.
Can I respond to that from an investor's point of view as well? So from an investor's point of view, we're also looking for exits at the same time. And sometimes it's a hard conversation to have with the founders to let them know that, because we've been with them for such a long time, if you've been with somebody since the seed stage and you've watched the company grow, at some points, it really becomes a family that you have there. But you also have a fund, and you also have investors, and you also have to, go out and raise money. And one of those things that you talked about, which is something called DPI, which is basically how much money have I actually distributed as part of my VC fund. And so we basically have to go back out to there, and we have to basically sell some of these things. Now, sometimes I'll say that it's actually a really good idea for early stage VCs to start to sell some of the later stage exposures. And the reason for that is because as an early stage VC, just imagine you have a $10 million fund. You've invested $2 million, with this company. This company has now taken that $2 million and they've made it, let's call it $40 million for you. It's a great fund. You want to distribute that money. What's going on in your mind as a VC is that you want to make sure that you lock in that money. And so what might happen sometimes is that the VC who's sitting with that founder is not going to want him to do things that are too, let's say, innovative, go too far out in terms of new markets or things like this, because he's trying to protect some of his downside risk as well. So I think I just want to say here is that, just in the same way that you're having conversations with your investors, the investors are also having internal conversations that might be hard with you. Don't take them in the wrong way if the investors want to, take some money out of the equation.
Yep. Thank you, Khaled. So, Nagati, you have exits written all over you. So your company is called Exits. You touched Kareem, you touched Fawri, Halan, and all these companies eventually go to good exits. How do you see, number one, how do you see the market, trend in the region and in Egypt when it comes to exits? Maybe you can start with this, and then I have many other questions.
Okay, so first of all, I was lucky enough to be part of, let me say, 3 big exits in the region. And honestly, all the money we made have been reinvested in the market. So this was also very good for the market, especially Kareem, which brought most of the money to the region. Also, I think there is a big psychological barrier on exits. I think Hussein can relate to this a lot because people sometimes falsely see that exiting early is bad. I honestly think it's the best thing ever. This is a personal opinion. Because when you learn to build something and someone else can take it and make it bigger and build on it, the learning curve you pass from the deal itself, like the Kareem Uber deal took like 2 years, the Halan deal took 2.5 years, the Fawry IPO, something similar, the Fatura deal, I was not heavily involved, but I was hearing our fund managers saying it took around a year, and Hussein is saying this now. So it takes time, and the learning curve of the process itself is a learning on its own. And the money that comes in, fresh cash that comes in, will make the founders and the team and the investors double down, and they become more and more trusting the market to put in the money. So I think it's very useful to exit, even if it's early, but at the right price, of course. And I think that the best thing to be done is what Hussein and the team have done, is to continue running the company, like what Mudassir also did with Kareem, what Munir did with Halan. I might be an early runner, so once the exit is done, I just used to leave the company. But I think this is better, and this makes the company mature under new umbrellas, which is beautiful for the ecosystem also.
Yeah, great. Given that you started your most recent company or advisory firm about this topic, like what made you start this venture, and how do you see the demand and supply for acquisitions and M&As in the market? How do you see the valuations? How should investors and founders think about valuations these days as well when it comes to exits?
Okay, so first of all, my co-founders are here, Ayman and Ahilla, so we thought that there is a huge market for M&As, and honestly, the startups have no one to serve them. Like if a small startup, $1 million or $2 or $3 million startup, or even $100 million startup wants to sell part of it, or even the whole startup, they cannot find an investment bank or a bankers that speak their language, that know what they want, that can work with them. We don't take, for example, retainer fees. We take only upon success, which is also very important for the startup, because most of them even don't have the money to pay the retainer fees. Even if it's a $100 million deal, sometimes they even don't have the money. And many founders here can relate to this. So we tailored a company actually for the ecosystem here, and we now have around 40 mandates signed from 6 different countries. So, and we have like 10 times the size of mandates we signed in pipeline that we couldn't sign because we don't have the capacity. So I think it was very obvious that this is much needed in the market. It was very obvious that we have the market there. It was like very obvious, but now the execution is very hard because the market is sort of shrinking a lot and the valuations are going down every day. So whoever wanted to sell for £10 last year is mostly selling now for 4 or 5 pounds, and the investors, many of them are unable to swallow this. So this is the biggest hurdle we have now, honestly, to be blunt.
Yep. And is it like M&A is happening in separate markets, like in Egypt and Saudi Arabia, or you see like deals cross geographies?
Look, we have all types of deals. Like some of our deals, we have deals. Egyptian companies acquiring Saudi companies, Saudi acquiring Egyptian. We have a deal that's not in Egypt, it's between Saudi and Oman. We have deals from Iraq. We have deals all over the Middle East. What we focused on is if we can create value to the company that we're selling or the company that we're looking for a company for them to buy. If we cannot create real impact and real value, we didn't sign the company. Because this is what matters. If we're not providing value, there is no reason for it. But we have all types of deals. But to be honest, it's mostly Egyptian companies being sold. Let me be frank. Because this is like the price of oil shows this, and the price of the dollar here shows this. But there are some very, very successful Egyptian companies, maybe 2 or 3, that are able to buy other companies. But other than that, I think it will be mostly inflow of buyers buying companies from Egypt, which is also good for the economy.
Yeah, thank you.
Yeah, I just want to follow up, and I think, yes, we have a lot of acquisitions taking place now in the market, and probably majority of companies coming from the GCC trying to expand to the Egyptian market, and you do it through acquisitions. And there are different types of acquisitions happening and taking place. Definitely could be oil prices kind of contribute to this kind of drive, but I think it's more coming from the idea that Egyptian market is so complex on its own, and it's so different. It's not like GCC. Maybe we speak the same language as GCC, but even like consumer behavior and customer behavior, and even the market structure is so different. And it's also different from Africa because we have a very different infrastructure in that sense. And kind of the code or the know-how that you have built in GCC or you've built even in Africa, because I've been advising a bunch of portfolio and non-portfolio companies coming from Africa trying to expand to the Egyptian market. Egypt is a bit of a different market. You need an operating know-how. You need someone who've already fought it for a year and a half in order to acquire a certain license for you to be able to ready to operate and ready to operate in the market. You need a team that already have learned a lot over the past period in terms of the downfalls and seen the lots of challenges happening in the market to be able to kind of start from their ending point in a way or another. And that's why maybe acqui-hires, and it's a very interesting time, by the way, to start exits, I would say, and amazing time to start it because there's a huge opportunity coming up for the coming period. And that relates a lot to the first point that I said, that there's a lot of unannounced exits that took place over the past period, particularly from the investor side rather than the founder side. Maybe a lot of people, when we speak about exit, they consider exit as a full exit of the company. But as Hussam said, it's a partial one, right? And probably there was a lot of misconception in the market that Fatura got sold and Hussam probably enjoying a drink or two in the Bahamas. But no, he's still working, right? He's still building the company and the business. It's a very interesting time. Partial exits is happening on a kind of weekly basis, I would say, giving the opportunity for different institutions and different investors to come on board and add more value that me as an investor, I would say, won't be able to add because it's not my kind of core playground. I can deliver a certain value up to a certain extent, and it's the time for someone else to come, take some of my shares, still I can hold some to realize the up value of what's coming next, but for them to take it more forward. So,
yeah, thank you. Like Mohammed and maybe Khalid as VCs, like when does the conversation of exits, come up with founders? Is it when you first meet a new company, you're considering to invest? Do you expect the founder to have an exit plan, or is this something you do within your team? This is, at investment decision, and then are there cases where you as investors would encourage the founder to exit, rather than leaving the founder initiate the process?
So I think when we talk about exits, for us, we're in the seed stage place. So we don't really have a first conversation about exits. I think internally as VCs, we start to think about, is there a market for an exit, as an example? But that's just because we want to get in our minds, getting set to see, if we start to think about, this company in a couple more years, is there a clear path that we get there? Look, I think in general, when we think about exits, we say, number one, if you build, a great product and a great team, you'll find multiple ways, to exit that company, and that's kind of the core that we start with. Now, the part where you talk about, like, at what point do we start having some conversations with the companies about exits, is really just depending on, where they are in their life cycles. Usually, this actually gets, initiated, kind of externally sometimes. We've just had an example where we've had a Series A company, and they've actually now had an offer to be acquired. And so now we start the conversation of what does an acquisition mean? What do you need so that you get the proper acquisition? What does it mean to go through the entire process of an acquisition? And usually that's one of the first ways that we actually start the detailed conversation of that. We like to, the way we like to do it is we like to introduce them to an existing portfolio company that's already been acquired, so that they can sit down and they can, kind of listen to them of how that process has happened, what have been, the clear milestones for them to get that acquisition done, and then, then they start to come back to us with more and more questions. So unfortunately, usually the first acquisition, offer that you get, gets rejected, but it's a really great impetus for us and the companies to start having that conversation. And from there, we can start to kind of build out a plan of what we want to do over the next, 2, 3, 4, 5 years. Maybe I'll just pause there and pass it to Mohammed. But I think the last thing that I just want to say is unfortunately, we always do have to think about, what the exit plan is going to be. I know that, founders want to build, so that they can, dominate their field and build on forever. But at some point, everybody needs to have some sort of an exit. So I think, having that conversation early on is something that we've now learned as part of our Fund 3 to have those conversations with the founders early, because when it does come to an acquisition, secondary sale, or something like that, it's better to be prepared for that conversation as opposed to, sitting back and waiting for it.
I agree 100%. I think that, remembering a few of the discussions that we had over some of the founders, probably a possible exit scenario is definitely one part of discussion that we have or we think of early on from day one, where this company is going to head. But along the way, working with some or majority of the portfolio companies, we got to realize actually that there are two types of companies, right? The first one is you're building a business to exit, and you're building a business to stay. That doesn't mean that you cannot exit. You still can exit. But I mean, the main objective of you building the business is what? You want to build the business to exit at a certain point, or you want to build the business to stay. And that's create kind of a different story and different dynamics towards exactly what kind of strategy and steps we are going to implement, and what kind of considerations we need to have in plan to be able to plan some sort of a long-term exit on the or plan an exit on the long term in a better way, I would say. Also, it kind of set and put some sort of limitations on where you're going to head with the company from an exit perspective. If you're building to exit, that probably means that you're going to get acquired. There's no way for you to make it to IPO. And by the way, I don't see that IPOs and M&As are different, or one is better than another. And maybe we can tap on that at a later point, because everyone is like, IPO, that's the amazing thing. It's no different. And I think it's tailored for the business model. But anyways, so for us, it's really important from early days to make sure that we invest in mission-driven companies, because when you have a mission, you are here to stay, and when you are here to stay, then you have a lot of discussions along the way in terms of when you can exit. And then you can get validated by an acquisition offer that probably you can refuse and learn from and tap on and so on. I guess the question in general is really dependent on what type of business model you're running, what kind of market as well you're running into. And from what we have seen so far, an acquisition talk in GCC is so different from an acquisition talk in Nigeria, and it's so different from an acquisition talk in Europe, and extremely different from an acquisition talk in Egypt. And here it's different. We are not saying good and bad. We are just saying that you have to look for the options available on the market. You have to look for who potentially can come and acquire you at one point, and that definitely will reflect on how you are building a product, how you are building the business and scaling up. But sharpening the skills along the way, putting the strategy and accounting for a possible exit scenario at one point is important. And our approach to that is, I think, instead of looking at the year as 1 year, we look at it as weeks, and each week would lead to the other one. And kind of short-term objectives and short-term goals will help you a lot to kind of get to the ultimate target point where that's the kind of sweet spot where you feel like an exit or a merger, even opportunity, might add a lot of value to the business in a way or another. Introducing portfolio companies to each other probably is the best thing that anyone can do. They learn a lot from each other, and they help each other a lot in identifying where are the sweet spots, what are the lessons learned, and how to avoid and how to build on that moving forward.
Great. So back to Hussam and Nagati about the psychology of the founder thinking about the exit. How, Hussam, how did it work out in your mind? How did you think about it? If you can share a bit about the discussions among the founders, discussions with other stakeholders like employees, how do you approach this? What's your advice to founders or investors?
I think the most important thing was the institution working in microfinance, because this is aligned with our vision. So we expected to be approached by such an entity or like a similar entity, because we were disrupting this market. And in our opinion, because we are an infrastructure business, right? We have a big mission of changing the face of trade in Egypt. We are in the changing B2B e-commerce and financing and payments. So it's like big change to the economy. So we saw that an acquisition was required to take this to the next step and the step after this. Because the mission is big, and you need that force, and that you need leading players in the market, and you need players who have experience in those verticals to actually help expedite the vision. So the discussions happened earlier, much earlier than that. Even when we were starting the company, that we are building this company so that in 2-3 years there might be a potential exit, and that reflected on the way we managed our fundraising, for example. For example, we didn't care about bigger valuations, or actually we didn't like the idea of bigger valuations, because that would not help us being acquired, right? It wasn't in the right track. So we had also those discussions along the rounds where you can see big, massive rounds with big valuations. But then for us, this was a no-no, because if we do this, it will be too expensive for anyone to acquire, and we would go in another direction that we didn't see will happen from day one. So the discussions between the founders were easy. There were a lot of discussions about the price, about how we will continue, the shape and form of our engagement in the business after exit. But then we didn't kind of debate the core of it, which is that exit is part of the plan.
Yeah, thank you. طيب, Nagati, maybe also touching on the psychology part, but also what Hussein mentioned about higher valuations make it more difficult to have meaningful exits. And we've been having a lot of very high valuations in the past 2 years. How do you see this play from the market versus what you've seen before in other markets? Like, what's your advice from the current market, what you see, the deals right now? Any investor or founder out there, what advice would you give them?
First of all, what Hussam is saying is extremely spot on. Like, when we work with companies now to sell the companies, the more money raised, the harder it is to sell the company. Because if you raise $2 million and you sell, for example, at $20-30 million, it makes sense. But if you raise $25 or $30 million, it won't make sense except if you sell at 100 or 120. And those numbers are now extremely hard to obtain with the current setup of the market. The second thing is the company that buys, the buyer has to be able to absorb the team and, how did I say it, make the team part of it. Because we see a lot of people furious, like, we don't want to work in this company anymore, we want to leave. And this harms the exit, because most of the deals are usually, many of the founders have vesting to keep on running the company, and those issues create a lot of problems. So also the post-exit scenario is extremely important. So, and also there are certain sectors that are better than others in exit. So what I really liked about Fatura, actually I was a big lover for Fatura in the fund, because I thought they were asset light. Many other players in this market are asset heavy. It doesn't mean they are bad. They can also be good, but the only way for them to exit would be a big IPO or an Uber Kareem deal, which comes once every 10 years or something. But I would advise people be like Fatura, if you want me to say it like this. Raise only the money you need, don't overshow things, don't overinflate the valuations, because it only harms you. And try to take a certain sector of the market that is not done right, and do it right with the least amount of money possible. I also want to add something that Khalid was saying about the Saudi IPOs. We're working now, we were just in a summit under the auspices of the Prime Minister. Actually, Mr. Hassan, Mr. Okabi were with me in the summit, and we were speaking about trying to put companies into Tamayuz, which is Bourset al-Nil in Egypt. I think that a lot of companies, whether SMEs or startups, have huge opportunity to exit for the public market. I know that the stock market here is not the best performing globally, but a lot of people want to put money in startups or in companies, and there is no proper way to do this. A lot of it is done through things that end up to المستريح who collects 2-3 billion pounds and runs away because they promise a lot of crazy returns. I think that this is an indicator for the supply and the demand, and I think that we have plans and exits to do this along with other players. So I think that this is also a very good thing that is untapped, and it can be a huge way to exit.
Yeah, thank you. So I'm not sure if we have time for questions from the audience. Yeah, if any of you have any questions, we have one back there, or I believe anyone else.
Excellent panel, first of all, and I think I never came across to this, so well done, and you managed the moderator amazing. My question, I like also, some key takeaways. If each one of you can tell us one key takeaway, regarding this, so we can take it back home. I will appreciate that very much.
Yeah. One takeaway from each of them. Yeah, we'll end up with this one. Any other questions? Yeah, back here. Yeah. Yes.
So I just wanted to ask, when you're funding, what do you consider a VC capital? What's the product line there with VC?
Anyone would like to take this?
There's a lot of formats. You want to take this one?
Yeah, so I mean, a messy cap table, there's lots of ways that a cap table can be messy. Let's just start with a few of them as an example. So we're very much a seed to Series A type of investor. Some of the things that we've seen in the market is by the time somebody, for example, gets to a Series A round, there's sometimes when their cap table is that the founders and the employees don't own more than 30% of the company. And so that's a really hard thing to do as an early stage company, because if you only own about 30% of the the equity that's left, then you have to think about your Series B, your Series C, your Series D, and onwards, and that becomes challenging as well. So I think that's one piece where you can have a messy cap table. Another time where you have messy cap tables is when some people start to create different operating entities and start to put equity in different operating entities as opposed to just having it in one holdco location. That could also create a messy cap table as well.
Yeah. So before we go, you have another.
I guess we're coming from the same direction, and it's only messy cap table has only one definition. It's giving out too much equity early on and not knowing exactly what kind of business model you're running and how much cash you want along the way. And then you end up in a Series A holding 30% of the business, and probably one of your investors is holding 40. And then it's like, should I speak to you or your investor? Because basically they own more than you. Lots of shares, I would say, I don't know how to precisely call it without causing some issues, I would say. But giving out shares not in exchange for money, but in exchange for help and support, I would say, that usually doesn't come across really well. And we see it a lot on a lot of cap tables, and the value add coming from such shares is minimal. And when it tells a lot, by the way, about the decision-making capabilities of you as a founder if you give out a lot of shares to people just to help you out. It affects our decision in that sense. One case quickly on that one, I just looked at a cap table, I guess 2 weeks ago, where basically founders own about 17% of the business. The biggest shareholder in the cap table is a VC fund owning about 31% of the business. That is a messy cap table, and definitely and cap table restructuring is an ugly process. I personally don't like it. And it's not easy, and it doesn't come across as something that we'd like to do.
If I could just add one thing. For all those who are in the room who are corporate VCs or venture builders, a lot of times we see the cap table messed up in those kind of entities. Sometimes it's because the venture builder will say, well, I'm starting the fund for you, or I'm starting the business, and therefore I should own a significant amount. Agree, they should own a significant amount. But let's make sure that that significant amount isn't 70% of the entity, which makes it hard. Also, corporate VCs sometimes have this as well. Again, if the corporate VC is not willing to fund the entire process, kind of from 0 to 100, then again, they should start to think about what it would be like to get outside funding for it as well.
Great. So before we go to the final question of the key takeaways about the topic of IPOs, we've seen very few of them in the region, and we've seen a lot of recent activity in Saudi Arabia and UAE encouraging companies to list publicly there. Nagati spoke about local efforts, but if you would have maybe as part of your key takeaways to have more successful exits in the region, if you would advise your portfolio companies who are considering to IPO, which markets would you advise them to IPO in, regional or international, as part of your key takeaways? Khaled, maybe we'll move to Nagati.
Yeah, sure. So if you're going to go down the route of IPO, I always think that the IPO should be in the local market, or at least in the regional market. So I think in the region we probably have two main ones. There's one that's trying to vie itself as the leader, which is the Saudi market, and then you have the UAE market, and then of course the Egyptian market is here, especially if you're an Egyptian entity as well. What I don't think that we should be looking at too much is the idea of doing SPACs on the U.S. market again. We've gone through one SPAC. We were one of the early investors in Grab out of Southeast Asia, and I have to say we were on the roadshow with the company while they were doing their raise for the IPO. I mean, when you speak to U.S. investors, I mean, we realized this maybe after the 10th meeting, is that the U.S. investors, some of them actually couldn't really point to where Indonesia was on the map. And that was, one of those things that we learned after maybe, the 10th investment to say, this is where Indonesia is, this is where, the headquarters of the company is. And so what usually happens is that, there's lots of interest in the SPAC because you see these, these great numbers, these unit economics, you see a 200 million people in terms of a population. These all things look great. But what happens in a downturn, which is exactly what happened with Grab, is that these companies get disproportionately hammered in the market as well. And the reason why is because, again, you have these asset managers in the US and you have a retail population in the US that looks at it and says, where's Indonesia? Like, what is this company? And they're the ones who get hammered.
Yeah.
So I'm just going to go out on a limb and I'm going to say, I don't think our part of the world should be doing SPACs on the US market until we engage much more with the asset managers who are responsible for that market to really teach them about our region so that they don't disproportionately hammer us when...
Yeah. So we're running out of time, so maybe quick, last key takeaways from each of you.
No.
Takeaways?
Takeaways to have more healthier exits for the region, Egypt and the region.
Sure. I think the main takeaway for me is it's totally fine to have partial exits, and it's totally fine not to join the journey from A to Z, particularly for early stage investors. If you have kind of achieved your target returns, give space for more people that the company now and the founder now need in order to take the business forward into a new stage, I would say. The second thing is, and this is very important, by the way, because a lot of people would look how many shares I would hold. Share price will always increase, so that means I always will make more money. Yes, and I can understand, but no at the same time, because along the way, you kind of lose control, because we tend to forget that there is a lot of legal dynamics happening, and there is liquidation preference, there is a share class, and with each share class comes a different liquidation preference probably, and then when you look at kind of the opportunity value for you waiting 2 or 3 or 4 or 5 years to realize some sort of returns, more money on your share, from a liquidation preference perspective and share class perspective, you'd find like it's not worth it from a time value of money. So sometimes it's better take your money now, go out, recycle this money rather than staying for 2-3 years in order to get your money just because of this kind of certain dynamics. That would be my.
Thank you. Sam?
I think from an investor perspective, if I were an investor, I think I would have a very confrontational discussion about exits and the founder's point of view about exits before I enter into the company. So I'd actually ask in a straightforward manner, would you want to exit or not? When do you want to exit? How much would you exit for in terms of valuation and in terms of cash, actually personal cash that you get or shares or whatever. And I'd have to be aligned with their view on this so that, 2 years down the road, no one is surprised, right? And so you had this discussion with the founder from day one, and although there are there are no many exits in the region, but at least you should plan for success, right? Because the exit might happen, and then if you're not aligned with the vision, it doesn't have to happen in the way that you like. So I think I would do that, yeah.
Thank you. Nagati.
It's working out. I think the investors have to listen to the founders. Like the founders know if their company is at a good state to be sold or it can stay growing and they can keep on going. I really don't like it when investors push founders to either sell or not sell. I think this doesn't make any sense to me, honestly, because the founders they're driving the company. They know how big it is, how bigger it can be. They know details that no matter how the investor is close to the founders, they can never know 100% of the truth. And let's be honest, many founders sugarcoat and try to look good instead in front of their investors to get more money. So the investor will never have 100% of the view. So I think the founders should be the sole deciders to sell or not. But honestly, in those days, I would sell. Cash is king. With the dollar interest going up and the dollar itself going up, looks like the Fed is just pushing everything up. I think that the next year and a half or something, I think if you can sell, just sell and do anything else. This is what I would personally do. So, yeah. And my company will benefit. So I have to say this.
Yeah. So thank you, Nagati, Hussam, Mohammed, and Khalid. I believe our market needs more exits for it to be more sustainable, to grow in a healthy manner. I hope you found the discussion useful, and thank you for your time. Thank you.